Have you ever watched as stocks make explosive moves right after their earnings releases and been frustrated that you weren't able to participate in that move because it was just too dangerous to pick a direction on the stock until the earnings were actually released? Well, options traders have figured out a unique technique for scalping profits from the moves that stocks typically make after earnings are released, yet they actually close those trades before the earnings are released, believe it or not. Now, I'm the head trader of SMB Capital's options trading desk, and I can tell you that options traders carefully study the behavior of options before earnings are released and work hard to find ways to exploit those tendencies to make money without exposing themselves to the huge risk of picking the wrong side of an earnings move. So if you'd be interested in how you can make money on an earnings release, but be out of the trade before the earnings are actually released, then stick around because I think you're going to find this eye-opening. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so most traders are aware of the extreme moves that stocks make right after the quarterly earnings are announced for their favorite trading stocks. But the problem, of course, is that they can't know the direction that a stock will take right after earnings because the company's results from the previous quarter are a closely held secret for legal reasons. So it's pretty dangerous to place your bet and hope that you guessed right on direction. But what experienced options traders realize is that with some stocks, large moves in options pricing takes place before earnings are released, and so you don't need to expose yourself to the risk of an earnings move that goes the wrong way because you get out of the trade before the earnings are released in the first place. Now, most of you probably know something about options, but just for a quick review, and this will be fast. What's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock has gone way above the strike price of the call buyer can exercise his right to buy 100 shares at the strike price. In other words, he's entitled to buy the shares way below market. He could flip them the next minute and make a huge profit on those shares. Or conversely, on the put option, even if the market goes way below the strike price of the put option, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock has gone way below the strike price of the put, which of course saves him a lot of money compared to where he didn't own the put, and he's stuck suffering a much larger loss on his shares because their price has gone way below what they were worth before, but he had no protection against that happening. So all other things being equal, when a stock price goes up, a call option for that stock will go up because that right becomes naturally more valuable to the buyer. And when a stock price goes down, a put option for that stock will go up because the right naturally becomes more valuable to the buyer of the put option. So those are the basics of call and put options. So getting back to earnings, right after earnings are released, stocks typically make a large move of some sort, either up or down, really an outsized move compared to its typical day because the earnings release provides investors with a fresh view of the company and its future prospects. Well, the options market takes notice of this. And so options traders and market makers tend to bid up the price that traders pay for options as those options approach earnings. So you might ask why that is, and the answer is that the seller of that option, whether he's a market maker or an independent trader, by selling you that option, he's taking the risk that the options he's selling you will be triggered, in which case he'll lose money unless he has built enough profit into that option that even if it does get triggered, he can still have a decent shot at making a profit from having sold you that option. And that risk gets way bigger as earnings approach, so he's got to build more profit into the trade. Okay, so let's take a look at an example. There's a video game company by the name of Activision Blizzard, which trades under the symbol of ATVI. Now, ATVI was set to release its earnings on May 5th. So let's take a look at a popular trade known as a straddle that options traders like to use around earnings. And as you can see, on that day, ATVI was trading at a price of around 67.5. So in this case, the trader decided to buy 10 calls and 10 puts at the closest strike to that price, which was the 67.5 strike. Now, you may be asking why he decided to buy both calls and puts, and the answer lies in what is a call and what is a put. Remember, we mentioned earlier that calls tend to go up when a stock rallies and puts tend to go up when a stock sells off. Well, we have no idea which way that ATV is going to go after earnings, so it makes no sense to buy just a call or just a put because we'll get killed if we guess wrong, and we shouldn't be guessing. Anyway, trading is not guessing. Trading is taking positions where we have reason to believe that we have an edge and then exploiting that edge. So in this case, we've studied ATVI. And we've noticed that as ATVI's options approach earnings, there's a tendency for the options market, particularly for certain stocks, to pump the prices of the puts and the calls up as the options get closer and closer to the day that earnings are released. Now, the way that options traders measure how much premium is being pumped into options as they approach earnings is by a statistic called the implied volatility of an option. And we can cover exactly what that is another time. But for today, just please accept that the larger the implied volatility becomes on an option, the higher the price of that option. So in this case now, the implied volatility of the option is 45, 8 days before expiration. And as you can see from the prices, we paid $2.87 for the calls and $2.69 for the puts, which makes sense. It's logical for the two options to have about the same price when earnings are coming up, and the stock could move up a lot or move down a lot after earnings, but we can't know in what direction it will move. So let's first of all calculate the cost of this trade. And as you can see, the call cost is $2.87, but remember, that represents 100 shares of stock. So you multiply that by 100, and then we bought 10 of those. So that comes to a total outlay of $2,870 for that option. And we do the same calculation for those 67.5 puts, and you'll see that the cost of those is $2,690. So that comes to a total initial trade cost of $5,560. Okay, so now let's move forward to the end of the next day, and we'll see ATVI is now dropped about 3 points, which is very common before earnings, as rumors are flying around about what the earnings release is going to say, and some market participants react to those. And so, as you can see, just as you would have expected, the ATVI put has gone way up. We originally bought it for $2.69, and as you can see, it is now trading at $4.79, which is $2.10 higher than we originally paid for it the day before. But as you can also see, the call has dropped, as you would expect, but the calls only dropped to 137, which is a drop of $1.50 from its original price. So it's really important to understand the significance of that 60-cent difference between how much the put appreciated relative to how the call depreciated. So as you can see, the initial price of the straddle was a total of $5,560, but after the move was down to $64.11, even though the call went down $1.50 from its original price. The fact that the put went up $2.10 means that the total price of the straddle increased because the gain on the put was much larger than the drop on the call, and so that now the new value is $6,250, which is a profit of $600. But the more important point is why. Why did the straddle call drop so much less than the put? And the answer to that lies in the concept we discussed earlier, which is implied volatility. Remember, when we first put the trade on, the implied volatility of that 67.5 call was around 45. Well, as you can see, that has jumped to 48. And even if you don't understand the concept of implied volatility yet, as we mentioned earlier, it's easy to think of it as the price being pumped into the option as the option approaches a big event like an earnings release. And certain stocks tend to pump their options prices gradually up as they approach earnings. And so in effect, puts sort of a floor on the pricing of options, because even though ATVI went down, there's always a chance that the company will have a great earnings report. And so it's not safe for the option sellers to let too much price out of those call options because earnings are coming up and you never know what's going to happen. So that tendency to release value from options more slowly as they approach earnings is the effect that implied volatility is having on that call and the reason it dropped so much less than the put increased. What we just explained is the essence of this trade, and that even though the price moved hard against that call, it didn't drop as much as you would have expected because the earnings are coming up very, very soon. So what the trader decides to do in this case is to sell that straddle. In other words, he sells the call for a loss and the put for a larger gain, providing him with a $600 profit, and then rolls the trade to the 64 strike and does the same thing, buying the 64 puts and the 64 calls, having already booked that $600 gain from the first straddle. And this is a common tactic for options traders to use to squeeze more profit out of a trade. Now, the cost of this new straddle is $5.49, as you can see, being the combined cost of the put and the call. And so essentially, we started a new trade having scalped the profit on the old straddle. Now, the other thing I want you to focus on for educational purposes, just before we move on to how this trade concludes, is how the implied volatility of the options have increased. And I want you to see that, as we explained, as options get closer to their earnings release, their implied volatility increases, and thus the price of the options relatively increases. And so, as you can see, the options implied volatility just in one day have crept up to the high 40s from the mid 40s when we first entered the trade the day before. So keep that in mind.
I wanted to let you know that there really are sound, viable, long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective technique that some of the greatest investors in the world, like Warren Buffett, use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it.
Moving into the final days of this trade, you'll remember that we mentioned that we would exit the trade at the latest, right before the earnings announcements. Well, ATVI was scheduled to release its earnings after the market on May 5th. And so the tendency within the last few hours before the earnings release is for equity trading to get more dramatic and for the options trading fear factor to reach fever heights. And so on those days, you will often see big price changes occurring on the underlying equities and huge spikes in that options implied volatility that we've been talking about. So as you can see, a few hours before the earnings release at 2:15 p.m., ATVI had rallied and had now pushed up to 68. And in addition, you'll note that the implied volatility of the options chain has now shot up into the mid 50s, which is totally natural given the fact that earnings are coming out in a few hours and a big move is likely. And so here we are sitting there with that 64 straddle on. And so as you can see, the 64 call has more than doubled in value to $5.52, up $2.81 from its original cost, while the 64 put has dropped also, but only $1.97. And so again, as you can see from the calculation, the overall price we can sell the second straddle for is $840 greater than what we bought it for. And so if you then take stock of the whole trade, you'll see that we were able to scalp a total profit of $1,440 from the entire 8-day campaign. So the important lesson that I'd like you to glean from today's video is that you do not have to expose your capital to guessing on the direction of a stock after earnings. There's a solid way to play earnings so that you take advantage of the buildup of options volatility in the options leading up to earnings without being exposed to the earnings move itself. And the trade value is in a sense protected to a large extent by that buildup in options value because of the increase in implied volatility of all options leading into earnings, even ones which normally would have lost a lot of value if it were not in the hours leading up to earnings. This has the effect of putting a kind of a floor on the trade, which can really improve your risk reward trade-off in a strategy such as this. Professional traders are constantly looking for ways to improve their risk reward trade-offs in every trade, and the earnings straddle is a great example of an innovative way to do this. That's the way professional traders think and prosper.
Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window so you won't lose this video. Don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.